Okay, let us start, right? Okay, in the previous session, we have discussed about the corporate financial management functions. Okay, do you remember what are the functions? Okay, those who can respond can respond. Okay, what are the functions we have discussed in corporate financial management? As financial managers, you have to perform certain functions, right? We discussed about those functions in the previous session. Okay, the important functions are like, yeah, you want to say something, right? Okay, the basic functions are like, to start a business, we need capital, right? Okay, we have to find a source for that. That is a first function. And what do you call that technically? Sourcing decision is known as capital structure decision. Sourcing decision is known as capital structure decision. Why we call it as capital structure? Okay, usually the companies can raise funds from the public, right? It can raise fund from the public in the form of equity share, preference share, or in the form of debentures also, right? So that the financing function is known as capital. Can you please mute? The financing function is also known as capital structure decision because it's a decision regarding the proportion of debt and equity in the capital structure. And after you have raised enough fund, and I told you, the capital structure decision is based on two aspects. What are the two aspects? Cost of capital and market valuation of the firm. And the optimum capital structure is that proportion of capital which is having minimum cost of capital and maximum value for the firm. Then, okay, now you have enough fund with you. You have sourced either in the form of equity or in the form of preference share or a combination of that, or you can add debt capital also. That is known as debentures. Okay, now you have decided, right? Now, what is your next function? You have enough fund with you. You have to invest it wisely. What is that decision known as? Investment decision. And investment can be divided into two based on the time frame, short-term investment decision and long-term investment decision. So what do you call short-term investment decision? Short-term investment decision is known as working capital management. What is working capital? Working capital is the capital required for meeting the day-to-day expenses of the firm. Then what about long-term investment decision? Long-term investment decision is known as capital budgeting decision. Okay, in this session, we'll be discussing more about capital budgeting. Then what is the next function? Okay, you have enough fund with you. You have invested it wisely. Then you started making profit. Then what you have to do next? You have to distribute the profit to the owners, right? And in a company, what do you call the owners? Owners are the shareholders. Okay, you have to distribute the profit to the owners or the equity shareholders. Okay, what will you call that decision or function? It is known as dividend decision. Okay, what will you decide there? You have to decide how much of the profit should be distributed as dividend and how much is to be retained. And why do we retain? Because as a growing organization, we may have to invest somewhere or we may have to spend something, right? For that, you can utilize a portion of profit also. That is why we have to take a distribution retention decision. That is known as dividend decision. I hope it is clear. What are the functions of corporate financial management? Sourcing decision or financing decision or capital structure decision. Then investment decision. In investment decision, we have discussed about Short-term investment, long-term investment. Short-term investment decision is known as working capital management. Long-term investment decision is known as capital budgeting. Then profit allocation, that is known as dividend decision. How much is to be distributed as dividend, how much is to be retained. Okay, so far I didn't get any response. Hope I am audible.
Yes, ma'am.
Okay. Then shall we go to the investment long-term, sorry, long-term investment decision. What will you call long-term investment decision? It is known as capital budgeting decision, right? And what are the long-term investment decisions you have to take as a finance manager? Okay, like a long-term investment decision can be an expansion decision. Expansion means the company can open up a new branch either in your domestic country, or you can open up a new branch in the or you can have operations in overseas. That is one of the investment decision, expansion decision. Or it can be a modernization decision. Modernization means you can do sophisticated methods of production and all, or you can go for automation. Then expansion, modernization, or you can go for a replacement decision also. Okay, suppose you are doing a business for a quite number of years, and the machineries you are using got obsolete. Then you want to replace that, right? That is also replacement decision, is also an investment decision, because you have to purchase another machinery, and mostly the machinery, plant and machinery are costly, and the benefit can be derived for a number of years. That is why it is also an investment decision. I hope it is clear what are the investment decisions. Investment decisions can be an expansion decision, modernization decision, or it can be a replacement decision also. Okay, let us see how we can take a investment decision. Okay, basically, there will be a few alternatives, right? And you have to choose the optimum one. Okay, sometimes there may be 5 or 6 alternatives, and you have to choose the most feasible alternative. How will you decide that? How can you decide which investment opportunity is better for you? How can you decide that? You have to compare two aspects there. Okay, what are the aspects you have to compare? An investment decision involves spending, right? You are investing means you are spending something. For that, cost is involved, right? Okay, for every investment decision, cost is involved. And what is the other side of that expenditure? You expect a benefit, right? Actually, in every investment decision, we are making we are doing a cost benefit analysis. You have to compare your expenditure with your benefits. Okay, that is why each and every investment decision is known as a cost benefit analysis or cost benefit comparison. Then, yes.
Are you sharing screen?
Any doubt? You want to say something?
Are you sharing the screen or?
No. I'm not sharing anything now. After discussing the theoretical aspects, I'll be sharing an Excel sheet. Okay.
Okay. Right.
Then, okay, if you have a paper or pen, you can write down the points. Then,
Yes.
okay, we are talking about investment decision. Okay, how will you take an investment decision from the alternatives? Okay, you have to compare cost and benefit involved in each of these alternatives. Then the alternative which offers you higher benefit can be chosen. That is how we take an investment decision. Then, those who have done commerce or management in your graduation level might have come across these terms like capital budgeting decision. You might have learned there, and you might be familiar with the techniques like discounted techniques and non-discounted techniques. Discounted technique means you are spending usually we are discussing about capital budgeting, right? Okay, it's a long-term investment decision. Okay, you are spending now. Suppose you are purchasing a machinery, you are spending your money now, but the benefit will be uh, in the suppose life of the machinery is 10 lakhs, you can expect a cash inflow for 10 lakhs, right? And first year you may be getting something, second year you may be getting something, till 10th year you may be getting something. Then since the life is only for 10 years, at the end of the 10th year, we usually sell it, right? We'll go for replacement decision. Okay, the benefit derived from the first year, second year, third year, can you compare all these benefits? You know, time value is, you know the concept of time value, right? The money value is decreasing. The 1 lakh received in the first year, you cannot compare with 1 lakh received in the 10th year, because it is not having the same worth, right? That is why we have to apply the concept of time value of money in every investment decision. Okay, I think we have discussed the concept of time value in the previous class also. What is time value of money? Time value of money means every rational investors will have a preference over time, and we will be preferring uh, early receipts of money, right? Okay, if you are offered 1 lakh today, or 1 lakh after 1 year, which one will you prefer? Because you will be preferring the consumption of 1 lakh now. Because if you wait for 1 year, the money value may come down. And if you want an inflow at the end of the first year, what do you want? What you will go for? You will ask for an appreciation. You need an interest on that, right? That's why time value is important in every investment decision. Okay. The techniques for capital budgeting can be of two types. Those techniques which considers time value of money, and those techniques which doesn't consider time value of money. Okay, I'll share you the Excel sheet. Please wait. I hope the Excel sheet is visible. Can anyone respond?
Yes, ma'am.
Okay. Yes. Good. Let us consider two investments here. Okay, there are two options. Either you can invest in project X, or you can invest in project Y. Okay, before that, I'll tell you few techniques for taking a decision, taking a long-term investment decision. I'll tell you the techniques. Yeah. Let us discuss net present value and IRR. Okay, net present value means basically we have to compare two aspects, right? Cost and benefit. Cost is in which terms? Cost will be in which terms? Present term or future terms? Cost means you are spending. If you are purchasing a machinery, now you are spending it, right? A cost or your investment is usually expressed in terms of present value, so that you need not convert that. And what will be the benefit? Suppose, hope you can see cost and benefit I have typed here. In benefit, in this case, you are expecting a benefit for 2 years. That is what I have written here, CF1 and CF2. CF1 means cash flow for the first year. CF2 is a cash flow for the second year. And you suppose you are getting 50,000 in the first year, again 50,000 in the second year. The first year's 50,000 is different from second year's 50,000. Why? These two 50,000 are not having the same value because of time value of money, because of inflation, right? So that you have to convert these two into similar terms. Then only you can compare it with cost. Okay, how will you convert the CF1 and CF2 to present terms? How will you do that? Okay, in the previous class, we have discussed about two techniques, compounding and discounting, right? Hope you remember. What is compounding? What is compounding? Process of converting present value to future value. Okay, I'll write here. Present value. PV is present value. FV is future value, right? Okay. If you want to convert present value to future value, what do you have to do? Process of converting present value to future value is known as compounding. And the process of converting future value to present value is known as discounting. Hope you remember it. Okay. Here, how can you convert CF1 and CF2 to present value? You can do discounting here. That is what I have done here. Okay, how will you do discounting? CF1, 50,000, right? Divided by 1 plus k raised to 1. Because this is for the first year. 1 plus k. What is k? K is the expected rate of return. Okay, let us assume it as 10%. Okay, if you expect 10% interest rate, what is the present value of CF1? And how will you do CF2? How will you discount CF2? CF2 is in future terms. You have to convert that to present terms. How will you do that? Similarly, you can do CF2 divided by 1 plus k raised to 2. 1 and 2, what do you mean by that? Raised to 1 means first year, year 1. Raised to 2 means year 2. Like that we can compare, right? I hope it is clear. Any doubt? If you have any doubt, please ask. Okay. We are going to discuss these two concepts, net present value and internal rate of return. Okay, these two concepts are known as discounted techniques because these two techniques considers the time value of money. Okay, I'm not going into the manual calculation. Okay, I'll show you how you can find out NPV and IRR with the help of Excel functions. Okay, let us discuss that. Okay, I told you,
Class class.
I didn't get you. Talking to me or? Okay, these are the two projects. These are the alternatives available. Either you can go for investment in project X or you can go for investment in project Y. Okay. For that, which all inputs you require to take a decision? What are the inputs required to take a long-term investment decision? Can anyone respond? What are the inputs you require? Basically, an investment decision is a comparison of cost and benefit, right? You have to compare cost and benefit. Okay, how will you take a decision here? Either to invest in project X or project Y. How will you take a decision? You need two inputs, cost as well as benefit. What do you mean by cost? Cost is your outflow, how much you have to spend. That is cost, right? Okay, hope you can see outflow. Okay, under here, I have written 48,000 and 10 lakhs. Okay, 48,000 is expressed in terms of minus. Why? To show that it's an outflow. Hope it is clear. Outflow I have marked as a minus figure because it's an outflow, right? Then what the CF1, CF2, CF3, CFY, what is What is this? These are the expected inflows. Okay, in this question, you are given with expected inflows for 5 years. That is why I have written it as CF1, CF2, CF3 like that. Hope it is clear. These are the
Ma'am,
inputs. Yes.
excuse me, ma'am. One question. How we can define this means expected? How we can define this cash flows input?
Cash flows we can based on the previous experience, or you can expect actually in capital budgeting decision you need not estimate the expected return. Expected return, there is formula to find out expected return, but actually it is not under the purview of this topic. Here you will be given with both inputs, cost and future inflows will be given. Actually, you need not calculate the cash inflows. That can be based on an estimate, like you know that if you are purchasing a machinery, you know how much units we can produce per year, and you can calculate the expected selling price also, right? On that basis, you can calculate the expected return. But actually, these figures you will be given. Cash inflows you will be given. Outflow also you will be given. What you have to do is you have to make a cost benefit analysis.
Okay, ma'am.
Okay. Then actually I haven't calculated these values. It is already given. We just want to do a calculation. Okay. As you ask, there are calculations for expected return also, but that is not coming under this topic. Okay. The calculation of return is another topic. As I told you, when we calculate the return from equity shareholders, also there is a formula for finding out the expected return, so that you can compare the actual return and expected return. Okay. Here these inputs will be given. You have to make a comparison. Okay. Hope this is clear. These are the inputs for project X. Your outflow is 48,000. That's to show it as it as an outflow. You have to put a minus in there. Then let us calculate NPV first. NPV means, what is the expansion of that? It's an acronym. What is the expansion of NPV? Net present value. I'll tell you what is NPV. NPV means net means, you know what is net. You may be aware of your net salary and your gross salary. Which one is higher? Gross salary or net salary? Which one is higher?
Gross salary.
Gross salary is higher, and from your gross salary there will be some deductions, and your take-home salary is known as net salary, right? Okay. Whenever you hear net, you can assume that there are some deductions, or like some deductions are happening, right? Okay, here also net means you have to deduct cost from the benefits. Okay, what do you mean by net? Something has to be deducted, right? Benefit is your cash inflow. You have to deduct your cost involved in that. Okay, what you get by deducting cost is known as your net benefit. And it is net present value. Present value means, okay, here you have to make all your benefits, all your inflows into present value. That is why it is known as net present value. Then only it is comparable, right? Because cost is in present terms, all your benefits are in future terms. Okay. In order to have a meaningful comparison, two sides, left hand side as well as the right hand side, should be in the same terms. That's why you have to convert. That is what we have done here, right? Actually, CF1 is in future terms, but we have discounted it. We have discounted it so that now it is in present terms. Okay, then what do you mean by net present value? Net present value is your total benefits minus cost. Okay, then now let us see the Excel function for this. Okay. Hope you can see the column NPV. Okay. See the formula. Are you able to see the formula? Okay. What is the formula? Equal to NPV. Then you open up bracket there. Then you have to select the one more input is required. That is what is given here. Discount rate is also given. What is discount rate? Your expected rate of return, right? That is also required as an input, and you have to select that. Then you have to select the inflows. That is here it is from column D to H, right? CF1 to CF5. You have to select that and close the bracket. Then put a plus symbol. Then you select the outflow. Okay, I'll show you here. Okay. Let me do here. Equal to. Equal to. I'm putting an equal to. Then typing NPV, net present value. Then NPV. On NPV, you have to, the function will be appearing. Click there. Then this is the formula. You have to select the rate. Okay, I'll select 6%. Then put a comma. Then I have to select the range.
Cash flow range.
Yes, D2, sorry. Let me do once more. NPV. Then I have selected the range, the rate. Then put a comma. Then I have to select the inflows. Then I'm closing the bracket. Then put a plus symbol. Then select the outflow.
You have to make the row.
Yeah. Let me. Yes.
I'll format it is. That's it.
Yeah. I'll format it. Two places. I'll format it to 2 places. Okay. Hope it is clear. How can you find out net present value? What is the formula? Equal to, then you type NPV, then you have to select the rate, then put a comma, then select all the inflows. You select the range, then close it, put plus symbol, then select the outflow. Okay, listen. Since you have expressed the outflow with respect to, you have put a minus symbol, right? That's why you put plus here. Okay, if you have given the data as plus value, you have to put here minus. Okay. Then, I hope how to find, you got the formula to find out NPV. Then let us discuss another technique. What is the next technique we are going to discuss? That is IRR. Okay. IRR is an acronym for internal rate of return. Okay, listen. We are going to find out internal rate of return. Okay, I'll tell you what is internal rate of return. Actually, how will you take an investment decision? An investment decision can be taken by comparing cost and benefit, right? Basically, it's a cost-benefit analysis. Okay, here, okay, I have converted CF1 to present terms using a discounting technique, right? Okay, like how did I do that? CF1 divided by 1 plus k raised to 1, right? And IRR is like the discount rate. IRR is the discount rate which equates both sides. What are the both sides? Cost and benefit. Okay, are you getting it? What is IRR? IRR is the discount rate which equates cost, which equates the present value of cost as well as benefits. Okay. Oh, is that clear? IRR is the K. IRR is a K value which equates both sides. Okay, so that we can explain it in another way. IRR is the rate where your NPV is 0. What is that? IRR is a discount rate which makes your NPV 0. What is that? NPV 0 means present value of benefits minus cost is equal to 0. That discount rate is known as IRR. Are you getting it? Or do you have any doubt? I'll show the Excel function. I'll type here. Equal to IRR. Click here. Then you have to select, listen, if you want to find IRR, you have to select the entire range. You have to select outflow as well as inflow. Then close it. Okay, this is when I convert this to percentage, this is 6%. When I do the formatting, it will be 6%. Yeah. How will you convert this to percentage? Into 100. Then it will be 6%. Okay, what do you mean by the 6%? What is the 6%? Can anyone explain IRR? IRR 6% means 6% is assumed as K. At 6% K, your inflow and outflow will be same. So that the difference, the net present value will be 0. Is that clear? Then, okay, this is about project X, right? Okay, like that, actually you have to make a comparison between X and Y. The calculation of X is over. Then you can do similarly IRR and NPV for Y. Then I'll show the figures. What is NPV for project X? It is 469.96 and it is 4,88,000 for the second one. And here, when you compare IRR also, 6% for the first one, second one, it is 24. How will you take a decision? Okay, there is acceptance reject rule. I'll tell you the acceptance reject rule for NPV. Okay. How will you take a decision? If NPV is greater than 0, you can accept it. Okay. In these two cases, NPV is greater than 0, right? You got a positive figure, right? Two projects are acceptable. But whenever we have alternatives, you have to go for the higher one, right? The best one. Which one is better here? The second one, right? Second one means you will be getting 4,88,000 from this, and from the first one you will be getting only 469. So that when you have alternatives, first you have to check whether that particular alternatives offers you a positive NPV. Those projects which doesn't offer you a positive NPV, you can reject right away. And if you have projects offering positive NPVs, you have to go for the highest one. And you can make a comparison with respect to IRR also. For the first case, it is only 6%. Second case, it is 25%. Okay, the rule for the acceptance reject rule for IRR is like you can go for the highest IRR, or you can compare the expected rate of return with the discount rate. So you can see here IRR is greater than your expectation. Okay, basically your expectation is only 6%, but you can have a return of 24%. But what about the first one? First one is just meeting your expectation, right? The first one is just meeting your expectation only, but second one offers a higher rate of return. Which one will you prefer? Project Y or Project X? Which one do you choose?
Project Y.
Project Y, because it offers a higher IRR as well as higher rate of NPV also. That's why. Okay, like this we can have a comparison. Then have you heard of payback period? You know what is payback period? What is it? Payback period. Payback period means you have invested a particular amount and you are expecting return or cash inflows over 5 years. And you need to know in which year you can get the amount back. Okay, that is what is payback period method. I'll show you here how to calculate payback period. Okay, these okay, the same question I have done. I have taken here. These are the cash. 5 years are there, right? Project X. Let us do it for Project X first. 5 years are there, right? We are doing it as a tabular method. First year, second year, third year, like that we have listed down. Then cash flows you can take from the question. First year's cash inflow is 10,000. Then second year's 11,000. I have entered here. Then you have to consider the okay. Listen, this is a discounted payback period. Discounted means we have considered the time value here. Okay, how can you convert this to present terms? Hope you can see the Excel sheet. The cash flows are we have taken from the question. Then present value factor also you can get from the table. Usually in every financial management textbook, towards the end you can see the table value, or from internet also it is available, present value. The present value for the first year at the rate of 6% is 0.943, and present value for the second year at the rate of 6% is 0.890. Like that you can take. And what is this PV represents? Present value. 10,000 is in future terms, right? 10,000, when are you getting this? At the end of the first year. 11,000 you're getting at the end of the second year. 10,500 at the end of the third year. And these 5 years inflows are not comparable because 11,000, 10,000, all these values are having different worth, because it is there is a separation of 1 year, right? That is why you cannot compare. For comparison, you have to convert all these inflows into present terms. That is why we have considered present value factor. Then how will you get 943396? How did you get that? First year's cash flow is 10,000. You have to multiply that with present value factor. That is how you got 9433. What is the meaning of 9433? The 10,000 rupees you are getting at the end of the first year is having a present value of 9433. And 12,500 you are getting at the end of the fifth year is having a worth of 9340 only. Then what is the next step? You have to find the cumulative values. Cumulative values means first year you need not write anything. Second year, how did you get 19,223? By adding first year's and second year's value. By adding first year's and second year's value, you will be getting the cumulative value as 19,223. Then next year, you can add 19,223 with 8816. Like that, you find cumulative values. Then what do you have to do? You have to do what is your total inflow? Sorry, total outflow 48,000, right? What do you mean by payback period? Payback period means in how many years you can get your investment back. What is your investment here? 48,000. You want to analyze by how many years you can get your investment back. In this case, if you wait till the end of the fourth year, how much you are getting back? You have invested 48,000, right? If you waited till the year of 4, you will be getting only 39,129. But what if you wait till the end of the fifth year? You'll be getting 48,470. But it's not the exact figure, right? You have to know the exact years and months. How can you get that? This is a formula. If you wait till the end of the fifth year, you are exceeding the amount, but you need only 48,000 to get it compensated. So that you can do one thing. You just do your required amount is 48,000, right? 48,000 minus the next year's cash inflow. Next year's cash inflow is how much? 9340. 48,000 minus next year's cash inflow divided by okay, I'll show you that. 48,000 minus G10 is how much? Yeah, 48,000 minus cumulative value of that year divided by the next year's figure. Then you will get that with respect to months. Then you have to divide it by 12. Then exactly you will get the month as 11 months. You can get your amount back by 4 years and 11 months. I hope it is clear. $48,000 is your required amount. And at the end of the fourth year, you're getting only 39,129. To know the exact years and months, you have to do like this. 48,000 minus G10 is 39,129 divided by F11. F11 is the next year's inflow. Then this divided by, or this into 12, so that you can convert this to months, 11 months. Hope that is clear. Then let us see how many years and months it will take to get your investment back for the project Y. Project Y, it takes only 2 years and 7 months to get your fund refunded. Okay, which one do you prefer with respect to payback period? Which one do you prefer?
Project Y.
Project Y, because within a year of 2 years and 7 months, you can get your investment back, right? Okay, so that so far we have discussed 3 techniques to make an investment decision. Okay, basically, what is an investment decision? It's a cost benefit analysis. You have to compare cost with your benefits. And since your benefits are in future terms, you have to convert all your future inflows into present terms. That is why we call these techniques as discounted techniques. Then we have discussed NPV, IRR. What is NPV? NPV is the net present value. Okay, for this, net present value. Okay, for this, you have to convert your future inflows to present value and benefits minus cost. You will get your NPV. And what is the acceptance reject rule for NPV? What is the rule? And if NPV is greater than 0, it is acceptable. And if you have more than one alternatives, you have to compare the NPV values and you can go for the project offering highest NPV. Okay, that is the acceptance reject rule for NPV. Then what is IRR? IRR is internal rate of return. How will you define IRR? IRR is the discount rate which equates cost and benefit. And IRR means IRR is the rate at which your NPV is 0. Okay, here, how will you make a comparison? How much IRR you got for the 2 cases here? For the first one, it is 6%. Second one, it is 24%. Okay, you cannot take the decision by looking into the IRR values only. You need to compare it with what your expected rate, discount rate, 6%. The first project exactly matches your returns, right? Your expectation. The first project exactly matches with your expectation, but the second project is giving you a higher return than your expectation. Here, basically, your expectation was only 6%, but if you invest in project Y, you will get 24% return. Okay, is that good? That is why you go for second project, right?
Yes.
Then, okay, as rational investors or individuals, do you feel that can we have a comparison of 48,000 is a very less amount, 10 lakh is a higher amount, right? But what benefit you will get from investing in a higher amount? You can have return of 24%, right? That is why even if you spend a higher amount here, you can have a proportionate return also, right? Even if you spend much higher than the first alternative, you can have a higher return also. Then what about the payback period? This is a discounted payback period, what we have discussed. And here we have calculated in how many years you can get your amount back. And you have seen that first project will be paid back in a period of 4 years and 11 months. And the second one will, the second project will you pay back within 2 years and 7 months. Okay, if you have compared all the 3, IRR, NPV and payback period, which project is better? In all the 3 comparisons, which do you find better? Project Y, right? In all the comparisons, project Y is better, right? Yes.
Yes.
Okay, hope it is enough. If you have any doubt, you can ask. Any doubts here?
Can you please share this Excel sheet last week also?
Yeah, last week, this together I'll share.
Okay.
Okay. Okay, hope this is enough for today. Thank you so much.
Okay.
Thank you.
Thank you.
Thank you, ma'am.
Thank you.
Thank you, ma'am.